India currently faces a 2.77 trillion rupee import bill every single year just to secure the industrial chemicals and fuels needed to keep the economy running. That reliance creates a severe vulnerability to global supply chain shocks. We import all of our ammonia, most of our methanol, and over half of our LNG. But compared to those deficits, our domestic energy reserves are staggering. India sits on roughly 401 billion tons of coal and 47 billion tons of lignite. That resource isn't abstract. It exists as raw material pulled daily from sprawling open-cast mines across the... To bridge the gap between what we import and what we have buried in the ground, the cabinet has cleared an aggressive 37,500 crore rupee incentive scheme to alter the country's energy mix. Spearheaded by Union Minister Ashwini Vaishnav, the authorization aligns with the administration's broader push for austerity and energy security amid West Asian instability. The core mechanism of the policy is straightforward. It pays companies to convert domestic surface coal into industrial syngas, deliberately replacing imported feedstocks. A 37,500 crore commitment at this scale functions as a geopolitical defense mechanism, utilizing industrial policy to insulate the economy from global energy volatility. The government has designed this scheme to attract up to 3 trillion rupees in combined private and public investment across 25 major projects. The physical process requires avoiding traditional combustion. Instead of burning the dry fuel, facilities must gasify it, converting the coal into a synthetic gas mixture of hydrogen and carbon monoxide. Building the infrastructure to execute that chemistry creates an entirely new domestic ecosystem of incredibly complex, heavy industrial plants. That syngas becomes the highly valuable foundation for producing urea fertilizers, producing chemical methanol, and synthetic natural gas. Predictably, when retail investors see headlines about a multi-billion-dollar government subsidy, it triggers immediate sector-wide market speculation. The influx of government funding won't benefit every player equally. Many firms currently seeing market hype lack the technical infrastructure to actually utilize this capital. To evaluate this opportunity, we have to map the specific supply chain. We need to identify who secures the upfront capital and balance that against who absorbs the long-term execution risk. We begin at the top tier of the value chain. These are the primary infrastructure and technology partners tasked with physically building the gasification plants. This flowchart maps the ecosystem. At the top extraction node, joint venture leads Coal India, BHEL, and GAIL receive upfront capex subsidies covering 20% of machinery costs. They also secure 30-year coal linkages, guaranteeing their facilities never run out of raw material. Here is the critical trade-off. Securing that government capital forces these specific companies to absorb the primary execution risk of the entire initiative. The core engineering challenge is brutal. Indian coal is notoriously high in ash content, making it stubborn and difficult to process efficiently in a gasifier. This is the gritty logistical reality these companies have to manage before the chemistry can even begin. Historically, previous attempts to gasify this specific quality of Indian coal have been plagued by cost overruns and severe timeline delays. Operational success will depend entirely on their ability to match bespoke, often indigenous, gasification technologies to the unique chemistry of regional coal deposits. For CIL, BEL, and GAIL, that 37,500 crore rupee allocation is not a guarantee of future profit. It is a required financial buffer against the brutal realities of heavy engineering. Moving further down the value chain brings us to the second-order beneficiaries, the industrial off-takers who will eventually consume the syngas. Downstream in the flowchart, fertilizer PSUs and Indian Oil Corporation become the final off-takers. By substituting expensive imported LNG with newly produced domestic syngas, these players achieve long-term structural margin stability, completely insulated from global geopolitical price shocks. These are massive, capital-intensive facilities that will eventually rely entirely on this stable domestic feedstock to maintain output. But the major trade-off facing these companies is time. This policy provides zero short-term benefit to their immediate quarterly earnings. These off-takers must endure a multi-year gestation period, while the Tier 1 companies design, fund, and physically construct all 25 required gasification plants. These second-order plays offer a safer, execution-light investment profile. but they demand extreme patience before any valuation shifts hit their balance sheets. We also have to look closely at the government's specific funding mechanism because it directly dictates corporate strategy and project viability. The policy imposes strict financial ceilings. Incentives are capped at 5,000 crore rupees for a single project and a maximum of 12,000 crore for any single corporate group. Those caps force megacorporations into massive joint ventures. No single entity can easily shoulder the cost, so they must pool capital and diffuse the operational risk. While joint ventures successfully de-risk the projects, they inherently dilute the financial upside for any individual company's balance sheet. The policy intentionally creates a slow-burn infrastructure mode that requires share of capital. It's not designed to be a catalyst for sudden, explosive earnings growth for a solo player. The core reality of the 37,500 crore initiative is clear. It's a heavy industry de-risking tool engineered for a decade-long transition, not a quick market catalyst. Mapping these companies on a quadrant chart, timeline versus margin impact, reveals a strategic divide. Evaluating Tier 1 players like CIL means betting on their engineering execution over a decade. Meanwhile, downstream plays like IOC wait out the construction phase for stable payoffs.